Hello, and welcome to the NatWest Markets Weekly Watch. I'm Brian Daingerfield, the co-head of G10FX Strategy at NatWest Markets, filling in for John Briggs. In last week's edition of the Weekly Watch, we discussed how several key U.S. economic indicators released so far in August surprised in the positive direction. This week, however, economic data was more mixed. Core retail sales in July rose more than the consensus expected, but other housing market indicators and business survey data declined. The FOMC's July meeting minutes were also released, and they revealed that the Fed participants discussed slowing momentum in interest rate sensitive sectors and even flagged the possibility that the Fed could over-tighten policy. To discuss the outlook for US growth and the Fed, I'm happy to be joined by our chief US economist, Kevin Cummins. Kevin, I'd like to start with inflation. The latest CPI print for July came in softer than expected. Do you think that's the start of a trend of easier inflation?
Yeah, thanks for having me, Brian. The July CPI report was softer than expected, and we're likely to see a pretty similar performance in the August data. It's very clear, energy prices have come off. In fact, gasoline prices for August relative to July are down about 10%. So your headline CPI is probably going to show very little change on a month-to-month basis. But more importantly, the core, like last month in July, we're expecting another kind of below recent trend reading of 0.3%. And just to put that into a frame of reference, in the first half of the year, the core was averaging gains of 0.6%. So you're likely to see some moderation again this coming month. And it's similar to last month where we saw a lot of transportation components and airfare and hotels and travel related stuff, used car prices. We're going to probably see even more moderation on that basis, that the core potentially could be even a little bit softer than what we saw in July. So I think in the near term, we are expecting some moderation in core CPI. So for instance, in the back half of the year, we're expecting average monthly gains of just 0.3%. Obviously, that's above where you were pre-COVID, but it's certainly a step down from what you saw in the first half of this year.
So that sounds like it's some good news, maybe not good enough news for the Fed, but certainly good news relative to the first half of the year, as you mentioned. I do want to turn to the growth side. Growth is clearly moderated, especially in, as the Fed put it, interest rate sensitive sectors. But through all of this, I think it's fair to say the labor market has been very resilient. So I'd like to ask you, how are we thinking about growth right now? Do you think we're heading for a recession here in the US, or do you think we're already in a recession?
I don't think we're necessarily in one currently today. I think, the GDP data that we had in the first half of the year, the back of the envelope calculation of back-to-back negative quarters of GDP growth typically coincide with what the NBER looks at on a monthly basis with indicators. And typically you would see a recession if you had back-to-back quarterly GDP prints. But I think there was, some kind of idiosyncratic noise in some of the components that once you look at sequential annualized growth rates, some big volatile components like net exports and inventory accumulation or swings in that exaggerated any sort of slowdown. It was hard to make the case that the sort of job growth and broad-based strength that we saw in the ISMs and a lot of other indicators suggests that activity contracted in the first half of the year. The second half of the year, I'm not so sure about. It looks like, as you mentioned, the labor market, while it has shown a little bit of easing, is still very tight. We're still seeing, job gains in excess of 400,000, which really isn't consistent with the idea of overall contraction in the economy. Yesterday's retail sales report suggested some resilience at the start of the third quarter, but things can change pretty quickly. The conference board came out with their measure of CEO confidence yesterday, and that plunged down to only 34. So, CEOs are very pessimistic about the outlook. And generally, those are good indicators that, that eventually slips over to hiring and then it becomes self-reinforcing, where you start to see a slowing in consumption growth. And it's not to say that we couldn't see a couple of quarters, perhaps around the turn of the year, that we do fall into a recession in the U.S. The jury is still out on that, but I feel like the momentum is certainly downward. And the FOMC minutes yesterday did touch on this, that members of the committee definitely we saw the staff forecast did mark down their numbers in July versus just the prior meeting in June pretty noticeably. So, I think the momentum in the economy is certainly slowing here into the back half of the year. So it's certainly a problem. The other thing, though, is that while the month-to-month gains in inflation that I touched on earlier should show some moderation, the outright level of inflation is still very high. I mean, in our forecast, even with that sort of moderation on a month-to-month basis, we're ending the year at the core well above 5%. Obviously, the Fed's target is only 2%, so it's going to put the Fed in a really difficult position going forward, in the fact that your economy is probably slowing and perhaps even contracting, but inflation remains stubbornly high and throughout the forecast. It's something that was touched on in the minutes with regard to, presumably inflation will moderate. The Fed will get help from the fact that outright growth is, very weak going forward. That should help inflation, but inflation's a lagging indicator. So, the jury is going to remain out whether or not the Fed's going to get back to 2% through the forecast horizon, really.
So you mentioned that it's a very difficult environment for the Fed, and that's certainly true. Some signs of moderation in monthly inflation, but still stubbornly high on an overall perspective, and some slowing growth. I want to run you through where the market is pricing for the Fed, and then ask you your opinion on the Fed outlook from here. So here's what the market is pricing: about a 40% chance of a 75 base point rate hike at the September meeting, and including September, about 135 basis points of total tightening through March of 2023, implying a peak policy rate of around 3.6%, but then expectations of easing of the policy rate from May 2023 onward. So with that backdrop, how are we feeling about the Fed, both in the near term? Do you think 50 or 75 basis points is more likely at this point? And do you agree with the market that there's the odds shift towards cuts before the second half of next year?
So in the near term, I think it's still our longstanding forecast has been that they would step it down to 50 basis point hike in September. We'll see how they're between now and September 21st. You will have another round of monthly key data that the Fed will really take its cues on. So, if we're right and we see the core CPI come in to show a little bit of relief relative to earlier gains, and we only get a 0.3 on the month, the increase, similar to what we had in July, I think the Fed, is probably, now that they're already at neutral, that they probably wouldn't mind stepping it down while they have the opportunity to 50 basis points. We'll also get the August payroll report. The July payroll report, if anything, was stronger than expected. We saw a huge miss to the upside. Now, August typically is a softer month for payroll, so relative to expectation, that often underperforms. So I would think that we're going to see a smaller increase in payrolls, certainly smaller than what we saw in July and August. So I think that would be consistent with our call for a 50 basis point hike, but it'll really come down to the data. And if for example, core inflation starts to reaccelerate in August relative to July, and it seems like July was more of a one-off than the new potential sort of monthly gain we can expect in coming months, then I don't think would have any sort of problems hiking by 75 basis points. So right now it's pretty much a toss-up, and 40% chance seems like a reasonable expectation for a 75 basis point at this time. With regard to rate cuts next year, I think that's really premature. I think, unlike other hiking cycles, typically the Fed, doesn't have the inflation that we've seen over the past, year and a half or so. So it would readily try to avert a recession and try to provide as much stimulus, even though it's debatable whether or not it's quick enough to carry into the economy to try to prevent a recession. The Fed will, generally do all it can to avoid a downturn. But I think the Fed is really focused, and we saw it in yesterday's minutes, that they're not going to come out and say we're willing to risk a recession. But for the most part, I think their sole goal that they are trying to achieve here is that they bring inflation back down to 2%, even if it does lead to a recession in the near term. I think even from some of the more dovish members, if you look at Minneapolis Fed Kashkari or Chicago Fed President Evans, the message has been that they're going to get to a level where they think is a certain level of restriction on policy, in policy terms, and then keep it there to make sure that inflation goes back down to 2%. So they're not talking about rate cuts in 2023. Certainly not the first half of the year like the market expects.
So I do want to bring it back to the coming week, and specifically the Jackson Hole conference, at which we are expecting a keynote speech from the Fed chair. Now, I think you kind of hinted at what you're thinking. We may or may not hear from the chair based on your discussion of data dependency and some of the important data coming up. But I was curious to hear, what are you expecting to hear from Chair Powell, assuming he does speak? Are you expecting any potential change in tone relative to, say, the July meeting or the minutes? And do you think it's possible that we get a signal about what the Fed might end up doing in September?
As far as Powell, I think he's going to reiterate a lot of the similar talking points that he mentioned, really focusing on inflation more so than the growth side, at least for now. That they're going to continue to move into restrictive territory. We're going to get, an unusually large rate hike of either 50 or 75 in September, but they really are keen to see what happens in the CPI report, the jobs report, the ISM report in September, that I don't think he's really going to unveil or suggest one preference over the other ahead of that September 21st meeting. So I don't expect to hear too much new there. I did see Powell is going to be speaking on September 8th. At a Cato Monetary Policy Conference. He's going to be taking part in a moderated discussion on monetary policy. So, I would think that they won't have all the information by then, mainly the CPI, which is the most important piece of information heading to that September meeting, but it'll have a little bit more than they will in Jackson Hole, because they'll have at least the employment report and the ISMs there. So, that we may get a little bit more information from Powell about kind of gearing up ahead of that FOMC meeting than we will in mid-August at Jackson Hole.
Great. Well, thank you very much for joining us, Kevin. And thank you to our listeners as well for listening to the Weekly Watch. As a reminder to our listeners, we're going to be on a 2-week break, so this will be our final podcast of the summer. So we'd like to wish our listeners a very happy and healthy remainder to your summer. And also, as a reminder, if you enjoyed this podcast, please be sure to like and consider subscribing to our channel to receive additional NatWest Markets, economics, and market strategy content. Thank you.